Alrighty. Doc here from North America. Good morning, good afternoon, and good evening. Let's see, how's the sound there? Sounds like I have sound. Yep, there it is. I hear it. I hear that sound. Cool. All right. It is a holiday here, so it's been a 3-day weekend. This is the third day. Everybody's kicking back and enjoying. There's just cocktail parties and swim parties and just kicking back and enjoying. And we've been lucky here in the East. We've had sunny days, sunny warm days, and things are trying to grow like as if it's middle of summer, which is kind of interesting. But that's what it does. It does, and then the craziest thing of all is the jet stream is dipping in the western part of the United States, and they got like a foot and a half of snow, and it's just dipped. The jet stream dipped down, and then it's gonna zip back up again. So it went from like 90 some odd degrees down to like 30 degrees or 28 degrees, and this is Fahrenheit. So for those that are used to the Celsius thing, we've gone about from something like, well, I guess you could say it's like 32 degrees Celsius down to 2 degrees minus Celsius, and that's happening tonight. And then tomorrow it kicks back up again. I guess tomorrow afternoon or something like that. So just a strange dip in the old jet stream. So anyway, let's see what's going on here. I saw that we went into the sell in the euro. There's the euro, and we tried to get in there into the weekly sell. You can see it's very close there. And LSLS, how you doing? Oh, you know what I didn't do? Hey, I just remembered. Wasn't I supposed to look up option spreads? Was it option spreads? I'm doing fine. I've been over enjoying myself over the 3-day holiday. Over enjoying myself. But wasn't I supposed to go help you find options? You know, how to put some spread on or something? I just remembered that just this moment. Does that make sense? Is that what we were supposed to do today? I was supposed to go find options? And I promise I'll do it tomorrow morning, but I don't want to tangle up the machine. I can try to do a little bit. We can go look for some options on this. But yes, we need to do that, right? How to hedge for an intraday trading. That's it. That's what it was. The doing like a back spread. Well, see, intraday trading would be, so what you do is like what we do is, let me see if we can do this. Maybe we can do this and I can do it on another machine, and then I can screen share into it and we can look at it. Let me try that. That might be a good idea. Let's see, which machine is this? So right there. Can I do it on that? Yeah, I think I can right there. And so we'll do that. I will turn it on and we'll go after that, and I'll show you what I was talking about, like the back spreads and shorting the futures or shorting the spot, and the carry is only like 26 pips. So and during the trading day it moves lockstep, so it's a fine one too. Yeah. Hey Rokas, how you doing? Juicies. Can we call you Juicies? Yeah, options are a really, you know, I think I've said this before. Back in the late 70s, early 80s, when we started trading options, listed options, we really thought that by the year 2000, we really thought options would be like everybody'd be using them correctly, and the markets would be marching along really interestingly from it and so forth. And really what it's come down to is it doesn't seem like they use the options that correctly. At least in my mind, I don't see it. So a little disappointed that more people are not using options, and options are much more normal. But then I guess there's no doubt that the complication, as I talk to you, I'm opening up a options platform on another machine. So let's see. Let me do that too. And so we were really surprised that options weren't really being used as well as we thought they were going to be used, and some of the funds, these public funds have really abused the options really poorly. And what I mean by abused them, what they're doing is they're selling premium naked, and that really puts pressure on the portfolio. They think they're making money. They keep on thinking that they can sell premium because they're long and or sell. It looks like I'm getting it up, so we'll see. And so kind of just I guess I can say is I'm disappointed that the education is poor. Not only that, what is it? It's I have friends. Let's see, Monday, September 7th. The market is holiday is observation, Labor Day, equity options markets will be closed. Okay, good. Okay, so that's fine. And so one of the things that really disappointed me more than anything else is that not disappointed me. One of the things that's really been positive is people that I discussed that idea with, and we talked about on the trading floors back in the 80s and the 90s, have made free videos, and I played them because they work for the Options Clearing Corporation, and so they work for the like one friend who was a trader on the floor is now he went back and got his PhD, and he's an economist for the Options Clearing Corporation. And another friend of mine that was partners with me in my hedge fund, he does free webinars for the Options Clearing Corporation of explaining options. And I think I've showed you those. Not you guys. I've showed these things about, I don't know, maybe 2 years ago on here. And another one of my friends is like, well, the other guy I didn't get along with anyway, but he's like he's like a vice chairman of the Options Clearing Corporation. So some of us who believed that the options education was important gravitated to the number one options operation on the world, and that is the OCC. And the OCC, let's screen share into that a little bit. Let's do we're going to do an options conversation here today. And we'll look at some of the products like we always do. We'll look at all the charts. We'll do the same thing there. And but the OCC is the Options Clearing Corporation, and it's the biggest bank in the planet because it clears all the option trades. And people don't realize that. So here's the euro. Let's see, there's the euro there. Let's see if I go like this. I need to do this once. So I bring this down to, what we can do this is, I wonder if I can do it this way. And then we go with the trade. And let's see. I think I've got something here. I think I've got it figured out. How about that? Okay, we do. Okay, so that's the November. So let's look at the November. There's the options. Okay, they're quoting them live because options are live. And so that's going on. And now, what do? We move that up again like that, I guess it is. Can I do that? Yeah, like that. And that's the question. Let me see. Let me just switch this and see what we got going on here. You're going to see an option chain. You were going to see an options chain. What happened there? Okay, there we go. All right, there we go. All right, now let's see if we can do this. Make this a little bit taller, like that. Sure doesn't want to do that, though, does it? How about that? Why doesn't it do that? We'll get this in a second. If I go big like this. Maybe if I go like that for the time being. All right, let me do this. Let's bring this down. Maybe we can do this. And what you're seeing here is an option chain. There we are. And so that's the options chain, okay? And so you can see the bid, like right here, that's the bid. See it right there? There's the offer. There, and then, and they're bidding in pips. You can see, like, in this case here, we're looking at, let's go back to the euro really quick. And let me put euro up there on Dukascopy. There's the copper we were looking at on Friday. And there's the euro. Now this is a spot. You can see it's moving down, and And let's see what we can do here. We go like this. There's the future. There's our uh, quantitative. You can see the Chicago quant, my work. It's bearish just like the way J4X is. And then let's switch back again to the options. Right there. Now, if you were going to get long, okay, so very small numbers. Yeah, we'll make that bigger. We'll get this all set up. Let me see how I do this. Let's see, what is that? We go like that. How do we do this? No, it doesn't do it that way either. Let's see, go like that. Let's see if we can isolate it like that. There's the puts. And you can see here's the strike prices right here, right here at the end where I'm highlighting. And then this is the bid. See it down the second one where the arrow is. Can you see the arrow? Can't tell if you see the arrow. Let me make this bigger too over here. And let's see if I can make this larger. Let's see if that does. Is that any better? And then let's see. Let's see if we can make these larger. What I can do is I can give you the prices. Oh, I guess it's detached. That's what it was. Okay, good. There we go. All right, so it detached. Now let's see if we can make those larger. Let's see. If I right click it, customize. Let's see. Expand drop down panels. Symbol action. Let's see if what that does. Let's see. There must be a way of making this larger. That's not any better? They're all small, aren't they? Let's see. Oh, wait a minute. I found it. No, that's the strike prices. That just expands the strike prices. Let's see how I can try to change the font on this stuff here. Expand down, drop down panels. Show action menu. What is action menu? Detach, help. Let's see. Help to place stock order. Export. I wonder what export does. To a Microsoft Excel sheet. Let's see if it goes to my spreadsheet. Oh no, it's a different computer. Wouldn't that be great if I could throw it on there? Okay, so could you make the window full screen? Yeah, it is right now. See, like that. That is full screen. But there must be a way of making the font bigger. Let's see. Let's see. What I can do is I can read you the prices. Wonder if I can enhance my. No, that'll mess it up. I don't want to mess with the screen here. Let's see. Add. No. More on. Let's see. What's that? Quick quote. I wonder what that does. Does that help any? That's another one of those. Is that getting it any bigger? It's done something. It's separated one of them, hasn't it? There's the quick quote. Let's see if. No, that's that one. We want the other one. I want this one here. Let's see if we can. Layout. Let's see what the layout does. Volume, open interest, customize. Can we find a font? Let's see. Can we find a font? Load defaults. Let's see. We'll keep on pushing a few buttons around here to see if we can get this to go larger. Attach window. Now symbol actions. Let's see what symbol actions are. Let's see. Add. Default quotes. Quote toss. No. Can you see that at all? Is that still too small? How can we enlarge this? Fundamentals, earnings, trade, quote. Create now. I wonder what the default is. Here's some of the spreads we was talking about, like the back ratio, that type of thing. So in other words, let's do this. I think, can you see these at all? You know, I mean, can you see these prices right here? The strikes, the bid, and the offer. And there's the strike price. And this is the November contract right there, which expires in 60 days. So you could, what my idea is, how I've traded these throughout the years, is I put what we refer to as back spreads up. Let's see, if you extend the window from corner, and it may become larger. No, it is already extended from corner. See, what it is that it's this is, here you go, like that. See, that's just the strike prices. I got it extended. The whole page is, here it comes. You'll see it in a second. The whole page is, see that? There's all the strike prices. So it's not changing the font. I wonder if I could. Let's see. You would think there's something here where I right click it and it lets me expand that font. All products. And so we had it narrowed down. So we're just going to go back to like 14 like that. But let's see if we can still find a way of changing the font size. Always on top. Show action menu. Show me your action menu. How to place this now. How to place now. Print now. Print view. Page setup. Let's try page setup. Here we go. I think we got something here. Size. There it is. Is that a little bit bigger? Let's try it again. Print page setup. Wonder what take snapshot does. Let's try that again. Oh, I see it. It's up somewhere else now. No, what is that? I don't think that worked. Let's see. That'll be like printing or something like that. Close. Okay, let's try that again. I think we're in the right area. Page setup. And then let's see. Margins. Landscape. Size. Size looks like that should be able to increase it. You know, Super A. Let's see what that does. That didn't do anything either. Let's try it one more time. Setup again. Page setup. Let's put bigger numbers in here and see what happens. 3, 3, 3, 3, and 3. Portrait. What's that do? That didn't do anything either, did it? All right. We'll have to work on that. Hey, MHB, how you doing? We're just playing around trying to get these options to work right so you can see these things. And so, well, let's work on the strategy. Let's say right now, LS, what would you like to be? Long euro at the moment, or short it because we're in a daily sell but a weekly buy, so it's kind of a little precarious there. But would you like to, what kind of position would you like to put on? And then let me show you what type of option position I would put on to hedge the underlining product. And that's what we'll try it from there. And while you're figuring that out, I'm going to keep on pushing some buttons to see if I can get this thing to enlarge in itself. Export. Let's see. Page setup. I think page setup would do this, you know? Why don't they have like a font? You know, just a button there. It says, you know, font, size. Super B, tabloid. Doesn't seem to change the font when I do that. That's what's really odd. And this here is just the strike prices. These are spreads. And let's see, what else? What is that? Whoa, what is all that? Oh, that's kind of neat. So it shows you October, November, December, all those strikes, January, like that. Euro buy. Okay, let's take a look at Euro buy. MHB says Euro buy. Let's go with Euro buy. All right, so you buy the euro. Okay, so now, oh, and you know what we need to do is put the delta on here too. So let's see if we can do that, the setup. Let's go and the setup, putting a delta on there will be a lot easier, you know, because it, let's see, page setup, and let's see, no, that's fine with that too. You can put, when you get on a, let's see if we can change this, custom quotes, basic price quotes. Let's see, open interest, position. Which one's this one? That's instrument option code. Here we go. Delta. Let's see if we can get the delta. The delta's in there now. See that right there? That's the delta. Now this might be a little small for you guys, but what you see here is, now we take a look at, let's do this. Let's just go back to the November contract like that. And you have your delta over here. What the delta means is that this option, right, let's say, okay, let's go like this. Now let's look at J4X really quick. Okay, as you can see here, and let's move this over like that. Okay, so you can see here the product is trading at 118. Okay, 118.20 bid, 118.21 offer. All right, so now we're looking at the 118 put, and here's the 118 call. Let's see if we can highlight that. So there it is right there. All right. Now, the delta is 45. What that delta means is if the euro goes from 118 to, let's say, 118.20 to 118.60 and goes up 40 points, it means that the option, the pips on the option premium will go up at least 18 pips. It's 45. If it was a 50 delta, it would go up 20 pips. And that's what the, yeah, I know, it's very small, and it's having a hard time. I can't find the font to change it. I'll keep on working on that. But that's what that means there, okay? What I can do is I can tell you the price. You can barely see the price, but I can tell you the price. So now the option, the 118 call, is trading at 176 pip bid, 184 pip offer, okay? Wide market, 8 pips wide, and obviously you don't take the offer and you don't hit the bid. What you do is you bid in the middle, okay? So you'd bid, say, 179 or 180. You might lowball it a little bit. Bid 179 and see, let it sit there for a few minutes, and then bid like 180, move it up just 1 pip. So, and we'll try to find a way to enlarge in these quotes. So I can see them normal, but I can see what you're saying. It's, wonder if I can do it with the OBOS. Let me see if that does it. Let's see if I can do the OBOS and change the font on that. Let's see. Let's see. streaming settings. I'm afraid to play with it, but let's take a look at the settings just real quick. Scene double clicked. Always minimum size tray instead of taskbar minimum size. I'm not going to play with that because I don't want to wreck the broadcast itself. So the objective here is, how do you hedge yourself? You're long the euro. How do you hedge yourself without having to use a stop? Okay? And there's two ways of doing it. One is you buy the euro, and you can go buy, say, now the one, see right here, the 181, does that help any? Wait a minute, down at the bottom. Let's see what that does. When I clicked on it to buy it, let's see if we can make that larger. Let me reduce my I'm not going to worry about that. Let's see. No, I don't see it again. I don't see the font size. All right, so let me just get rid of that. That's going in there, go to a live order. All right, so what you see here down at the bottom in the red is the bid and offer. Is that any better to see? Now, the strategy would be is this. You would buy the put, buy the 118 put, and the delta on it is 45. All right, so in other words, if you buy the euro and it drops 40 pips, more than likely you're losing. I see. If it rises, if it rises 40 pips, you make 40 pips on the euro, and you lose about 20 pips on the puts. And that's how that works. That's now naked hard on both. In other words, the put is protecting you about 50%, but as you see it dropping, obviously, you can see here, the 118, let's say the thing crashed. You bought the product, and it started to crash out of nowhere. And the 119 put, right there, you can see goes up to 88 from 35, which is 55 pips, and you lose 45 pips on the what do you call it, the cash itself. Now that's one way of playing this game with options, just doing it what we kind of refer to as like a synthetic. That's what we refer to as a synthetic, okay? And so you're not fully hedged at that moment, you're partially hedged delta-wise, but you are 100% fully hedged if the product falls apart. So in other words, let's say all of a sudden, out of nowhere, I'm going to describe it in extremes so you can get a comfortable feel for the prices, okay? All right, let's say out of nowhere, the product falls from, 118 and change all the way down to, 115 and a half, all right? Down to there, okay? Now, obviously, you're long, you lose 250 pips, okay? This is just an extreme. I want you to see how that works, all right? But at the same time, the 250 pips you lost on the long, on the puts, you make, the pips now are trading at 309 to 315. So let's just say like 312 or something like that. So you paid 130. Let's say you paid 130 for the puts, and now they're worth 312 pips. So you make 212 pips. You've just lost 250 pips on the future, or the cash. See, it's working with it, and as the further it gets into the money, it makes more money, and it's 1-to-1. Okay, so see, you're not really getting crushed any more than what you did 100 pips ago. Okay, now, obviously, if it goes up, and what you were looking for, the put, let's say it goes up 100 pips. So your cash now goes up 100. You're making 100. At the same time, your puts fall down to about 92. So you lose like 36, 35 pips, and you made 100 pips. Okay? Now that's a simple way of not doing the stop and just buying the option. Okay? Does that make any sense to both of you? LSLS and MHB, does that make sense? Do you understand that? See how it has that relationship? And the bid and the offer is in pips. So, and that's what you do when when you're trading an option, or when you're buying an option or selling an option. What you're doing is you're buying a contract, and the contract is priced. You're looking and you're using this like in this case here, it's 118. I mean, you could do the 117.5, make it a little bit cheaper if you're really bullish and you don't want to be that much hedged. You want to be partially hedged. Sure. So what happens is, this is just one way, and then I'm going to show you how professional option traders play games to shrink that 40 some odd pip factor down even more. Okay? And so let's do that again. You decide, you're looking at the math, you decide technical analysis, you want to be long. So you go and you buy the cash. Okay? Now, and this is each option represents $125,000 worth of equity. All right. So I think with Les had said to me, he was looking for $1 million worth of euros, or $1 million worth of dollars. The volatility, if you're doing an intraday trade with this, the volatility is not going to mean a lot, I mean, no doubt if it's the volatility is going to shift, the decay is not going to mean a lot, because if you're trading for 40 or 50 pips and you think it's going to go up 40 or 50 or 60 pips over the next, say, 3 or 4 hours or 5 hours or 6 hours, something like that, the option premium or volatility will shift, of course, against you, and the decay will work against you. But the thing is that the delta of the hard asset that you have by buying, being long the spot, moves much faster. So you're only losing a percentage, and if you're hedging yourself with like a 40 delta or a 45 delta, it's a lot easier. Okay, and so you're saying to yourself, okay, I'm willing to lose 40 pips to make this trade. It's not going to happen because you're doing an intraday trade. To lose the 40 pips, you'd have to have a demonstrative reverse move, or it'd have to be like 200 or 300 pip move to lose that much premium. But as it's dropping, your delta is increasing, so you're losing less and less and less. So like when I did the extreme of saying it moved 300 pips against you, you can see that you lost 300 pips on the cash, but you turn around and you make like 260 pips on the option. So you're only really risking like 40. But again, you're not really even risking 40 because you're pretty much you're going to, it's going to be around that area, 35 or 40 pips, right around there, and that's about it. Your option is going to increase and help you out more and more, but it's always had that gap to start off with. And what we do as option traders, and I don't want to get into the sophistication yet until you feel comfortable understanding the movement of the option itself. You can do it on any time, high volatility, low volatility. Especially if it's an intraday trade. Most of the time, the volatility is going to affect you when it's been dramatic. That one is think or swim. And they're very good in options. So it's Toronto Dominion, TD Ameritrade. So it's Toronto Dominion Ameritrade. They bought Ameritrade years ago, and it's called TD. That's Toronto Dominion out of, I guess it's out of Toronto. And I just want you to feel the flavor of how options move. That's the objective right here. Nothing more than that. I don't want you to think about volatility, and I don't want to think about decay or any of the other, Greeks. I just want you to think about. I want you to be able to appreciate how it moves with the spot. Does that make any sense to you? And I'll do that over again. So, here the product you can see on J4X is trading at 118.16. It just was there on a bid. Now it's 17 bid. 18s are offered. It's a nice tight market by Dukascopy. All right. Especially on a holiday. That's a really good tight market. And you decide that you want to be long. So that means that you're trying to protect your long. So what do you do when you're trying to protect a long? You're buying a put. No, IB's okay too. IB's all right. You can, if you have IB, you can find it on IB just as easily. I didn't want to make it too. I mean, I could probably throw IB up there too. That might be bigger. I just opened up the Thinkorswim thinking, what the hey, that might be easier. Right. Okay. So in a high volatility situation, even when you're buying an option with a 45 delta, you may not make as much theoretically as you thought you were going to make, but you'll still make money. So in other words, instead of let's say you buy it at a high volatility point, some type of major news is coming out in an hour, and I mean, I'm not even sure. You have to monitor. The best way to judge that would be to watch what the volatility is beforehand, and then after the news comes out, see what the volatility is, and then do that a few times before you try to do the option trade. In other words, get a feel for it, how much volatility you're going to lose. Instead of losing 30, let's say the product goes up 100 pips. You bought it, it goes up 125 pips. That's a volatility day. And so in other words, you bought the 118 put right here, this one right there, the 118 put. See how I'm highlighting it there? And it's at 132 at 136, okay? And it goes up 125 pips. Well, the chances are is that without a volatility factor, the puts are going to be quoted basically around 89 to 93. And if the volatility drops out of it, they could be quoted, say, 86 at 89. All right. So now you've lost, instead of 45 pips, you lost maybe 52 pips. Okay. Maybe 6 or 7 more pips. But the thing is, you've made 125 pips on the cash. See what I'm saying there? Oh, you do it afterwards. Okay, so yeah, there's a good chance that the volatility has already been knocked out of it. I'm not really sure. I haven't been trading the options in the currencies, so I'm not really sure. Over let's see, I don't think I've traded options in the currencies in 6 or 7 months. I think I was trading the options more during all the Brexit stuff going on, and I was trading it, at other times. And I've traded it throughout the decades. So let's see if we can find what the volatility is. Let's take a look at that too. Let me put that in there. How did I come up with this? I got the delta in there. Let's see if I go like this. Customize. What was it? Instrument details. Theoreticals. Okay, so let's put the volatility in there too. Let's see. So there's delta. There's gamma. Theta. Theta is more time and volatility. Where's volatility at? Vega? Maybe they're calling it Vega. Theoretical price. Delta intrinsic value. Let's see what they're doing here. Price. Let's see what theoretical price is. Okay. So they're telling you, I guess that must, could that be the volatility? There it is. Implied volatility is 8.7, they're saying. 8.67 in November. But each individual option, you know how let me see if we can do this. Let me shift something for a second. And let me see if I can show you this through IB. Let me see here. Let me do this. Where do I do this? How do I do this? There we go. Okay. Let's see if we can do this. There we go. Okay. Let me see this for a second. I'm going to see if I can get the other one up. No. Okay. Option chain. There we go. We want the individual. 6E. Let's see. 6E. Trying to get the individual contract up. And I've got spreads up right now. I want to get out of spreads. Let's see if we can do this. 6. What is it? 6E. Let's do it this way. Let's put the euro in there. EUR. Let's see if I do it this way here. EUR. Enter. Yeah, so they don't have the cash. You know, they actually are trying to reflect the cash, but let's try this. Let's put the futures in there to start off with. That's what we're looking at right now. We're looking at the futures contract. Let's put September in there. Okay. 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 Quote. No, it didn't do that. Let's try it again. EUR. Enter. The futures. Oh, let's see what happens with the future options. Okay, that's what it's doing there. All right, let's try that one more time. 6. That's a euro. Enter. Future. September. All right, now. What is this doing? Is this doing? This is doing a. Okay, good. All right. See. So this is doing spreads. I think at this point, I want to go naked long. Maybe not. This might be. That might be doing it. Let's try this. Let's minimize this and bring this down. Can we detach this? Maybe. There we go. That's bigger. Let's see if this will do it. Not available. Okay, so the 118. I think this is trying to look at. Let's show you what I'm looking at right now. I want to move this up a little bit like that. Yeah, like that. That's good. And let's see if we can show you what I'm doing here. There we go. Got to find the right mouse. So I'm dealing with a couple computers here. There we go. All right, there. That's a little bit bigger. Now, I think that's trying to give me spreads. So let's see if we can move this over. And you can see the bid and offer a little bit better. We're looking at the 118 right there. Okay, so now you can see here. Let's see if they can. When you on IB, when you hold your mouse on it, usually it'll show you the volatility, and they're reflecting implied volatility at 7.3. Now, Thinkorswim was thinking, what were they saying? It was 7, basically, volatility. But each strike price is going to be a little bit different. Let's see if we can. Analytic tools, profile. Let's see if we can get it to show us the actual volatility for each of the strikes. Yeah, see, there it is. There's the implied volatility, but it's not running it. I'm not sure why. Let's see. Sometimes it, let's see. Config, maybe? No. Usually it fills in right here. They're not really reflecting, and they're just giving this. And the volatility moves on a bell curve. And now we're really getting complicated. Doc, today USA is closed, but you are working. I don't really consider what I do working, so. But yes. I always like to do my webinar. I like doing my webinar. It gives me purpose. You know, I don't have a trading floor to go to anymore, so it gives me purpose. You know, I like both of them, but right now it's not reflecting the volatility. And what you want is let's see if I can do this with another product. Let's say you're looking at ESs. Let's see if they're going to reflect the volatility. So when I put my cursor, see that? I put my cursor over to, we're looking at the S&P 500, okay? And notice there's like, let's see, the S&P, let's throw the S&P up on Dukascopy, and I'll show you what I'm talking about there. IB, right there it is right there. So it's trading at 3,420, 19 bid. Okay, now let's look at the 340 call and put. Quoted at, 1875, offered at 1950. Notice it's a bigger box, and it's reflecting the offer is at 25.7 volatility, 07. So basically 25.1 volatility. The bid, the volatility is 24.62. Okay, see how IB, and usually a TD does the same thing. Just putting your cursor on there. Now that's at something at the money, because as you can see on the trading platform, you know, right now the S&P 500 is trading at 3,420. Okay, so I guess that's right there, and so you can see there the offer is 26.5 volatility. Go up a couple strike prices and it's 25.7 volatility. See that? See, it actually shows you the volatilities, and as it rises, you're going to see the volatility drops. See that? 25.12. Next one is 24.75, 24.47. It keeps on getting lower in volatility as it goes further and out of money. Okay? And let's see if we can go back to the currency again and see if it'll update it now. Sometimes you just have to wait for it to be in there for a little bit. So right there. There we go. And we're looking at the November contract. Are we looking at the November contract? Yeah, so right here, the 18 right there, 126 at 132, which is the call. And okay, now it's still not reflecting the volatility. See, it says NA not available. NA not available. It keeps on showing us unavailable, the volatility calculation. And it's not putting in here the implied volatility either. So it comes down on the individual product, the way you have your option page set up. All right, but we were looking at the deltas. That was our objective, so you have a flavor. So in other words, you want to probably hedge yourself outright when you're trying to trade without using a stop. Let's say the product is trading at one, in this case here. Let's go back to the euro again. And I'll show you some of the games we do as traders doing the same thing. But this is a basic way to start off with doing it. Okay, so here you got the spot is trading at 118.19 basically, bid at 19 offer. Nice and tight markets by Dukascopy. We go to the 118 strike price, and this must be October. Yeah, it's October. And if we go like this, something's wrong here. I'm not sure what's wrong with this. This doesn't make sense because Thinkorswim. Oh no, I guess that's right. There's the puts, 132 at 136. Okay, and so you would be buying. Let's see if it's showing the volatility on that too. No, still not showing the volatility. And you can see the volatility on the put side is implied at 8.1 right now, and it's not. We know that as you go down the option chain, it's going to be cheaper. Okay. For cash, how you doing? Okay, so let's see. LS says maybe because U.S. markets are closed. Could be, or it's just a setting. And when you go to trade options, you're going to make sure you get set up so you can see the setting. Mr. Duck. Mr. Big. Hello, Mr. Big. Hello, Mr. Duck. Okay, so that's how that works there. So what you're doing is you're looking at, you're going to buy something that has about a 45 delta, and that stops you from having to do the stop. And so you can put that on, buy the put, and let it go up and down for a couple hours and see if you can get out of it for a plus, since you're betting that it's going to go up. And that's the simplest way, okay? Now, what option traders do, professional option traders will do, is sometimes they will go and sell something that's like $3, 300 pips away or 400 pips away, because they don't think the volatility is going to be anything dramatic. And what they'll do is they will go and sell an option because they bought a put. They'll sell a put. And this way, the decay and the volatility shift is protected more. But at the same time, obviously, if you had a 300 or 400 pip move, then obviously you are not as covered, hedged, as if you had bought just the put and not sold anything. And so traders will do that. They'll go and do that, and they may even go and sell calls, spreads, and they'll play different spread combinations. And that's how they try to cut down on that small loss. I recommend, I really do. I think that the smarter way as an options trader for almost 40 years, for a non-experienced options trader who's trying to trade the product, the underlying product for the hard delta and being semi-hedged, the more logical thing in the beginning is to buy just something with a 40 some odd delta and buy the spot, just the mano to mano, one-on-one. Okay, I think that's the better deal because you're trying to do it intraday trade, and you're probably better off doing that. And if you get your 60 or 70 pips up, you're definitely going to be able to sell your put that you bought for 132 or 133. You're going to take, it goes up, if the spot goes up 60 pips, you're going to be able to make your 60 pips on the spot and sell your puts for about a 50% loss, but you're going to make a 100% gain on your spot. And so that's probably the better way to go. And you want to go out, 1 month, like 2 months out. Like we're in September now. You don't want to buy like October. You might want to buy like 60 days or 55 days or 70 days or 62 days, something like that. You want to go further out. And that would be the rudimentary hedge. Okay? Now remember, you're not trading, you're not putting the put on to make money. You're putting the put on to protect the spot that you're buying. And so you expect to lose money on it. Okay? And long as let's say you do it and it doesn't happen. Okay? Let's say you're convinced that there's going to be volatility, and you go and you buy, in this case here with the euro trading at 118.22, you bought the 118 put, and you paid, in this case here, the 118 put is now quoted at 131 bid at 136. Okay, so now you may end up paying like 133 or 132. And let's say it only goes up 30 pips, and you're making only like the difference between the two. Let's say you're making 12 pips or 10 pips, and that's it. And you didn't get your volatility. Take that money and run. Take the profit, because that, if it doesn't run more than, let's say you were hoping for 60 pips, you were thinking, oh, this looks like it wants to go up 60 pips, it's going to be volatile, and it only goes up 32 pips, and now you're only making, like, say, you're losing, let's say you're losing like 12 pips on the put, and you're or 13 pips, right around there, or 14 pips in that range, and you're making 30 or 28 pips on the spot. Take it, because remember, it's going to have a decay factor. You put it on. Remember, I always say, what gets you in gets you out. You put it on with the idea that you were looking for an expansion of the spot, okay? And you were thinking you were going to make 60, 70, or 80 pips. The news comes out, and it only goes up 32 pips. Take it. Don't play with it. Or you can, if you put on $1 million worth, you have 8 of them on. Take off half of them. Right off. Take half of that profit right there. And then if you're thinking, okay, well, maybe as the European market closes, maybe as the American market 4 hours later closes, it's going to run up again. And then you go and take off more. But if it's not doing what you thought it was going to do, take something off. Take off 50%, take off 70%, something like that, and try to ride the rest of it, okay? Because remember, if the thing goes back to where you purchased it, chances are, let's say you bought the spot here at 118.22, and it goes up to 118, like say 58. It goes up 36 pips, and you make 20 pips. You make your 36 pips on the spot, and you're losing say 18 pips on the option. Let's say it falls right back to from 58. It goes back down. A couple hours later, you find yourself sitting there again now at 118.22, and you're going like, okay, this is really cool. I'm not losing anything on the spot. There's a good chance that if the volatility did shift, your options might lose 5 or 6 pips. Okay, or if it didn't, then it's going to be like maybe 1 or 2 pips. But that way, if you took off 66% of your position, it compensates for the loss on the last 3 lot. If you hold on to the last 3 lot or 4 lot, you're risking your profits. And so if you're convinced now that, let's say you put it on with the attitude that you thought that it was going to be volatile because of that news over the next couple days, then it has some legitimacy of holding on to a 3 lot or a 4 lot. But if you thought it was just going to be volatile for a few hours, you take the money and run, even if you only got half of what you thought you were going to get out of it. Because remember, you're holding on to the put. The put is going to decay about 1 to 2 pips a day. And so you don't want to be sit there married to a put and watch the spot go down. The spot goes down now from 118.22, and now you find a day later it's trading at 118.05. You've lost 16 pips on the spot, and your put might only be up 2 pips because it's dropping, it's decaying. It's picking up a little bit because of the fact that it's dropping and it's 60 some odd days, and you may not be making as much. So that stops you from getting stopped out on using a stop on your spot and not having any option on at all. The option gives you that opportunity, but remember, you got the decay factor and the volatility factor that will interfere in that to some extent because it's not monolithic, it's not static. It's dynamic, it's changing, it's decaying, but due to the fact that it's 60 days or 70 days or 58 days, it's not going to be decaying more than, say, a pip a day. So only real dramatics would be as if the volatility shifted dramatically. And that's why you want to do this as a paper trade a couple times to get a feel for the shift in volatility. If it's really dramatic or not really that much dramatic. You got to figure when, and that's awful low volatility, really. I remember the days I used to trade these products. They used to trade at 14, 15, and 16 volatility. I had cable trading at 25 and 30 volatility, with the crazy Brexit moves. And sometimes it was even 50 and 60 volatility. That's when you get in trouble. When you're buying a currency at 7 and 8 volatility, it's not less. Now, I didn't forget you, Alex. Let's see where are we at? Let's minimize this. How do I do that? So I minimize this. And let's go back to Thinkorswim. Right there. Is that it? No, that's not it. Okay, so what we do is we get rid of that one. And we go with this one with the option right there. All right, now let's go look at Aussie. Let's see if we can find the Aussie. And there it is right there. There's Aussie dollar against the dollar. And go take a look at the November. Okay? I didn't forget you. I just wanted to get that train of thought out first. All right, now let's go look at Aussie because Alessa said let's look at Aussie. And let's put Aussie up on, I could have sworn you said Aussie. Didn't you say Aussie? I'm looking for it now on the chat line. There it is, long Aussie. Okay. So now let's go and look at, there's November Aussie. Let's put Aussie up on the J4X. Dollar Aussie, right? Where's it at? Right there. There's dollar Aussie. Trading at 72.78. Let's see what the volatility. They're implying the volatility is about 12.5. Okay. And you know, we could probably find a chart that will show us historical volatility. And so now we're looking at the 72.78. So you can see here they do the strike prices in half. So 72, 72 and a half, 73. So in this case here, you would buy the 72 put. That's quoted at 122. Offer 116 bid. Okay. Now, if this product, now chances, you know, let's take a look at the Aussie. Let's take a look at it on, I'm going to go to mine a little bit first on the Aussie, just because it's a bar, it's not a hinky ASCII chart. So you can see, let's see what you can see. I can see, you can see, we all can see. There, no, not that. Right there. There we go. All right, so you can see here the high and the low of the Aussie. In this case here is 72.98 down to 72.23. All right, that's not too bad. So that's being pretty active. Okay, so you're looking at 72.98, and it's been as low as 72.22. Oh, that's a daily chart. Okay, so it's a 60, what's that, 70 pips wide on a daily. Today you can see, because of the holiday, the high is 72.98, the low is 72.70. It's only 22 pips wide. Okay. All right, same situation. So in this case here, you'd be buying the 72 put. It's quoted at 115 at 122 right there. See those right there? I'm highlighting it. Can you see that? Oh, no, you can't see that. I didn't do that. Okay, so let me go back to J4X. And let's also fix the screen to see the options. There they are. Now, they're itty-bitty, but there they are. Okay? You can see the implied volatility is 12.5. And that's not bad. You're going to get in more trouble when you're trading volatility of 30 and 40 and 50. Because that's where you, when it has that, sometimes it can swing 4 or 5 points in volatility, which can have a meaningful effect on the options themselves. Whereas at a 9 or 10 or 8 volatility, it's not going to be that bad. It's, you know, the chances of it going down more are slimmer. You know, it's going to go up in volatility more. It's going to go down. All right, now, like I said, the quote on the 72.5 is 114 pip bid, 122 offer, 6 pips wide. You know, you would bid in the middle of that, or even a little bit lower, and then move it up to try to buy it. And at the same time, it's easy to buy the spot because you can see the spot on Dukascopy. It's 90, you know, 72, 78, it's 79. It's right there. It's inside a pip, which is fine. Good quote market by Dukascopy. All right, and you would do the same thing again. And if the pip, in this case you're looking for it to go up, and it goes up to let's say it goes up 50 pips. All right, so you made 50 on your spot. And your puts are now going to drop down to 94 to 101. So they're going to lose, on average, about 18, 19 pips. Okay, so you make about a 30 pip market there. Let's say it gets crazy wild and it goes flying down. You're using the put for a hedge, and now you're not stopped out because you can just sit there and wait with no problem. And then 5 minutes later, you find the thing up 50, 60 pips. And that's the beauty of using the option versus using the stop. Because the stop, you're out, gone. Next thing you know, the thing is up, and you're shaking your head going, I knew it was going to go 50 pips up. I knew it was. How many times have we done that, traders, where you know something's going to do it, you can feel it in your heart, and your technical work tells you it's going to do it. And then you go out there and you put the position on, and you put a stop out there, you know, a stop loss, and it gets wild in the first minute or two, hits your stop, you're out, and then next thing you know, 4 minutes later or 10 minutes later, it's up there where you thought it was going to be. That's what buying the one put against, you know, $125,000 worth of Aussie, or buying 8 of them to match 8 puts to match $1 million worth of Aussie is the big difference there. Also, at the same time, you can take off slices of your position as you're making money, locking in some profits, and at the same time, oh wow, since the markets are closed, I'm not even paying attention to the time. So we just spent a whole hour talking about that. That's really cool. All right, I don't know if anybody else is coming in, but if there's any questions, and I think I'd probably get a text if there was if someone had to come in behind me. So no, I'm not seeing any text about me being overzealous on talking an hour and 5 minutes there. So, all right, does that make any sense to you? Since there's no market for me today, I mean, I got electronic market I could trade, but I'm not. You can see here. I'll show you. U.S. stock market is moving around. Let's see if we do this. Let's go to there. And let's go, and you can see we're having a very active stock market in the electronic market right now. We've been having that all night long. It's been very active. You can see here. Here's the S&P. You can see it's been active. Last night it fell down to 3,380, and now it's trading at 3,420. I mean, we're very active over here on the electronic market. Yeah, I'm free. I can keep on talking. So I'm just going to text Nicole and let her know. Going longer because we are closed today. Been on webinar 65 minutes. There we are. I know they told me I can do this, so it's okay. Oh, there's Janos. Okay, cool. There we go. Yeah, so now everybody get a simple, comfortable feeling about understanding by buying something with about a 45 delta, about 60 days out, how you could use that as a short-term trade instead of using the stop. Now, you're more than likely, most people are probably using a 30 or 40 stop to begin with. So what's the difference if you buy the options with the potential of losing 30 or 40, or doing the stop? You know what I mean? It's about the same. Once it gets past that point, your options, first of all, is going to start increasing in price. So you actually might start making some of that. That's what's really kind of fun about it. Imagine if it goes totally wrong and it drops 200 pips. Chances are you might only lose like 30 pips. Instead of like 42 pips, something like that, because the option volatility is expanding, and it's getting deeper in the money and more valuable, and so you're even more hedged, and so that your only risk is your risk is there. And let's say that some other news is coming out tomorrow, and it could pop it again, and so you could actually carry that put for a day or two. Now remember, you're going to have a little decay going on, and as it gets more valuable because it's falling down, the decay rate might be 1.5 pips a day, that type of thing. And also at the same time, when the product that the spot turns around and goes up, obviously volatility could decrease and squeeze the option a little bit more. But it does take that finality out of being hedged with a stop loss versus a option hedge. Now, does that all make sense to you? And I'll hold. I'll wait a few seconds for you to be able to type in your responses and questions. Did I miss anything? Oh, let's see what Aless says. Aless says that's because MHB was calling me. Was it? Oh no, it was Farkash. Farkash was calling me Mr. Doc. I like that. That's cute. No, you just call me Doc. Call me anything you want. Hey you. Let's see now. Aless says, your broadcasting resolution is maximum 7 pip. May please increase. I don't want to. I don't want to mess with the OBS because I'm afraid to blow something up. And I'd rather just have the conversation and tell you the prices themselves instead of you having to see them. Also, you could go put up the options on your machine, like I'm putting the options up on my machine, and that's just as good, So let me think. Where are we at here? So that's pretty much the name of the game there. And I hope that you're getting a grasp on how they work. Does MHB? Do you feel more comfortable with that compared to before or less? Do you feel a little bit more comfortable with how to use just a single option to hedge your long delta, your long spot? I like MHB. Why are you working? That's because I've been partying for the last 2 days. That's a good reason to just bring me back to reality there. Let's see. When we're long the Aussie dollar, we take the opposite side in the option. Right. If you're long the Aussie spot, then you want to be long the put. Okay. Now someone's going to get crafty with you and try to tell you, oh, you know what you can do? You can sell a call and take in premium. Don't. Because if something happens crazy and it drops 200 pips, by selling that call, you're only going to make like 70 or 80 pips. And if you buy the put, you're going to make like 175 pips. Take the risk. Take the premium risk and volatility risk. It's a lot easier. It's not as much of a risk as you think it is. Especially when the objective is not trading options. Your objective is to be hedged. Your objective is to buy the spot and make money on the spot. That's what you're shooting for. Now, if you weren't doing that, then the game changes, and there's a different strategy for that. But if you're just trying to trade the spot long or short, then you want to buy the call or the put with about a 45 delta with 60 days. Okay? Does that make sense to all of you? Because you're not going to marry that option. All you want to do is trade it for a few hours. And you don't want to get taken out by a stop loss, and then watch the product go the way you thought it was going to go 20 minutes or 30 minutes later. So, yes. The answer is yes to a less. You're long the product. You take the opposite option. You buy the put. Exactly. And now there'll be people out there to say to you, oh, you can save you can catch some premium decay, and you can sell the call naked against the long, but you're not. The objective is you're not trying to protect. You're not trying to be in something for the option. You're in there for the spot. You're trading the spot. So it doesn't make any sense. You're not really hedged as much as you want to. People, inexperienced people think you're hedging yourself. That's where the funds. This is where I started this off complaining about the funds. They go out and they do that stupid hedge, right? That's really a stupid way of doing things. And they're in there, and the next thing you know, it gets volatile, and you sold the call, and the volatility goes up on the call, and it gets volatile, and the spot goes roaring down, and they're in there for the long. And the next thing you know, it drops 125 or 150 pips, and your option only makes like 30 or 40 pips, whereas the put would have made like 90 pips, And so, no. And imagine it's something really insane happens out of that volatile point you were looking for, and it drops 300 pips. Well, you lose your 30 or 40 pips by being long the put, but if you were short the call in the money or at the money, you're losing like 150 pips. So, same thing with gold. You do the same game with gold. Same game with oil. And it is a holiday, so I think I will jump off. After an hour and 14 minutes or 15 minutes of talking. Let me see. Let me just answer your question. I will not leave you hanging. Before I start my singing, I will answer your question. Let's see. So how hedging with gold compared to... Well, let's take a look at that really quick. Let's see what the volatility is to start off with. More than likely, the volatility is very high. So let's take a look at the gold contract. And I would imagine the gold is trading in the 30s in volatility. Yeah, see, it's in the 20s. Okay. So let's take a look at December gold. They're giving us a 24.16 volatility. Okay, and it's probably come down from, it was in the 30s at one point. I saw that. And I see an implied. The September is right now the short-term option with just a couple of days left in it. How many days is that? It's got 2 weeks in it. It's trading at 38 volatility. Is that right? No, that's got to be. Which one's which here? You know what? Let me do this. Let me see if we can get the IB up there. Let me minimize that. And let's do this. And then let's see if we can put gold in there. Let's see what the IB says the volatility is. Their volatility seems to be a little bit more indicative. No, that's 19. Oh, wait a minute. That's September. Okay, so let's take a look at November gold there. The volatility is 22. So that's not too bad. But if gold goes to sleep, it could fall down into the, the 16 or 17. A 5-pip move. Remember, this strategy is not for carrying it for days upon days. This strategy is for trading it in a 1 day period, a 4-hour period, a 5-hour period. Okay? Capiche, as they would say around here? Understand, yeah? All right, then. It's singing time, guys and gals. So this is Doc from North America on a 3-day weekend. Doc's had too much fun already, trust me. It's nice to do the webinar to get me back into reality again there. And we will catch you all tomorrow, and we can talk about options again and so forth. And I guess that's about it. All right. You're welcome. It was easy to do. I hope you got a grasp on it. We can go through it again tomorrow. All right. Happy trails to you until we meet again. Happy trails to you, to all our